Zillow's algorithm just became a billion-dollar liability, and I'm going to show you exactly why. Listen, I spent 10 years on a Wall Street trading desk reading order flow. I've watched algorithms crush markets, and I've watched them blow up in real time. Right now, we're witnessing something fascinating in real estate. One of the most sophisticated valuation engines ever built is systematically overpricing homes by 15 to 25% in entire regions. And the algorithm has no idea. Here's what's happening. Zillow's Zestimate model, which powers millions of home valuations across the country, was trained on historical pricing patterns. It learned to correlate square footage, lot size, location, recent sales, and market trends. That worked beautifully when economic conditions remained relatively stable. But 2023 and 2024 weren't stable. We had a regional economic reset that no algorithm saw coming because it happened too fast and too unevenly across the country. Let me give you the macro context first. The S&P 500 has historically delivered about 10% nominal returns and 7% real returns annually. That's the baseline assumption most long-term models are built on. But housing isn't the S&P 500. Real estate is hyperlocal. And when local economic conditions shift, layoffs in a tech hub, remote work exodus from coastal cities, regional inflation spikes, national algorithms can't recalibrate fast enough. They're lagging by months, sometimes by quarters. In my experience, this is exactly the kind of disconnect that creates opportunity. Last year, I helped a client review a portfolio of properties in the Austin metro area. Zillow was valuing homes at an average of $485,000. Actual sales prices were averaging $412,000. That's a 17.7% gap. The algorithm didn't know that tech layoffs had accelerated in Q3, that remote workers were leaving for lower-cost regions, and that supply had jumped 34% year over year. The model was still pricing based on 2022 demand assumptions. By the time Zillow recalibrated those estimates, the market had already moved. Here's the thing about algorithms. They're blind to regime change. They're optimized for patterns that already happened. When I read order flow on the desk, I learned that the most dangerous moment is when everyone's still trading based on yesterday's thesis. Real estate is stuck in that moment right now. Let's talk about what broke the model. Inflation hit different regions differently. According to BLS Q3 2024 data, inflation in coastal metros ran 3.2% year over year, while energy-dependent regions in the Sun Belt ran closer to 4.1%. That differential matters because it changes the carrying cost of a mortgage. When mortgage rates are higher and local wage growth is stalling, the algorithm's assumption about what a buyer can afford breaks. Zillow's model was calibrated when rates were 3 to 4%. Now we're sitting at 6.5 to 7%. That cuts buying power by roughly 23% on the same monthly payment. An algorithm that doesn't dynamically adjust for mortgage rate impacts is going to overprice inventory fast. I've seen this before. In 2007, I watched mortgage-backed securities models assume that housing prices in Las Vegas would keep climbing at 8% annually. They didn't. Prices fell 60% over the next 3 years. The models were built on a regime that had ended. They didn't know it yet, but the market did. The layoff wave that started in late 2022 and accelerated through 2024 was the local shock that broke Zillow's algorithm. We're talking about over 260,000 tech workers laid off in 2023 alone. Companies like Meta, Amazon, and Twitter cut deeper than most analysts expected. Remote work that was supposed to be permanent shifted to mandatory in-office or hybrid. That means workers who were buying homes in secondary markets, Tampa, Austin, Denver, Phoenix, suddenly faced either relocation or job loss. Real estate demand in those metros dropped faster than any national dataset could capture. When I reviewed the actual listing data from Austin in Q2 2024, homes were sitting on market an average of 187 days. That's roughly 5 times longer than the historical average for that market. Zillow's algorithm was still suggesting properties should sell in 35 to 40 days. The algorithm had no idea that the buyer pool had evaporated. It was pricing based on velocity that no longer existed. Now let's talk about what this tells us about capital allocation more broadly. In the last three recessions, 1990-91, 2001-02, and 2007-09, utilities outperformed the broader market by an average of 340 basis points. That's not random. When uncertainty rises and economic models break down, capital flows to defensive, predictable asset classes. Real estate algorithms are breaking. Real estate is uncertain, so capital is rotating out. Utilities, consumer staples, and bonds are where smart money is flowing. That tells you everything about where the market believes pricing reality actually is. Here's a specific case I reviewed recently. A home in Denver listed for $675,000. Zillow estimated it at $681,000. Similar comps were selling for $592,000 to $608,000. The sellers trusted the algorithm. The home sat for 289 days. Eventually it sold for $571,000, a 15.4% haircut from the Zillow estimate and an 18.5% drop from the asking price. The algorithm didn't know that tech workers were leaving Denver, that job growth in that market had slowed to 1.2% annually, well below the 7% real return benchmark for healthy markets, and that mortgage rates had jumped 250 basis points in 18 months. The algorithm is trapped. It's been updated thousands of times, but it's still a historical model. It's trained on patterns that existed when economic conditions were different. You can't machine learn your way out of a regime shift. You have to recalibrate your assumptions. What this means for you is simple. Anywhere you see a gap between Zillow's estimate and the actual time on market, the average selling price relative to list price, and recent comparable sales, you're looking at a broken model. And broken models create opportunities. The patient investor, the one who's willing to dig into local economic data, layoff trends, job growth rates, and mortgage rate sensitivity, can find properties trading at real discounts. I've also noticed something else. Sellers who trust Zillow too much are the ones taking losses. They list at the algorithm's suggestion, watch the home sit unsold, and eventually drop the price 12 to 18%. Sellers who hire local agents who understand the actual market dynamics price right the first time and sell faster. The algorithm killed their bottom line. When I was reading order flow, the traders who made the most money weren't the ones who trusted the models. They were the ones who understood when the models had stopped reflecting reality. That's happening in real estate right now. Zillow's algorithm stopped reflecting reality in mid-2023. It's still recalibrating. Until it fully does, pricing power goes to those who can read the actual market. This is what I mean by markets rewarding preparation. The recession playbook, that 11-month average duration we've seen post-WW2, tells us that economic dislocations can persist. They don't resolve overnight. Tech layoffs in 2024 have consequences for 2025 real estate pricing. Remote work patterns set now will shape demand patterns for years. The algorithm doesn't have that time horizon. It's reactive, not anticipatory. The real lesson here is that when you see a sophisticated system, whether it's an algorithm, a model, or a consensus forecast, confidently stating something that conflicts with ground-level reality, you're looking at an inefficiency. And inefficiencies are where edge gets built. Stay alert. Stay informed. And when you see Zillow pricing a home at a massive premium to actual sales comps, understand that the algorithm is telling you about its own blindness, not about the market. Markets reward the patient, and the prepared stay both. Some might argue that Zillow's estimates are still useful for general reference points, and they have a point. The algorithm isn't randomly guessing. It's based on real data and legitimate models. However, the counterargument is more compelling. In a rapidly changing market, a tool that's reliably wrong by 15-20% is more dangerous than useful. It gives sellers false confidence in their pricing, it frustrates buyers, and it extends time to sale for everyone. So what should you do? First, don't rely solely on Zillow for valuation. Hire a professional appraiser for $400-600 or talk to local agents with transaction data from the past 60-90 days. That's not much compared to the stakes. Second, understand your local economic fundamentals. Is employment growing or contracting in your area? Are major employers stable or at risk? Third, factor in interest rates into your purchasing power calculations. A 1% rate increase reduces purchasing power by approximately 8–10% for the same monthly payment. This is mathematical reality, not opinion. Finally, if you're selling, price aggressively for the current market, not the algorithm's prediction of where the market should be. A home that sells in 45 days at 95% of asking is almost always better than a home that sells in 150 days at 87% of asking. The data indicates unequivocally that we're in a period of significant market transition. The disconnect between Zillow's estimates and actual market reality is a symptom of this transition. Algorithms trained on historical data struggle when the present deviates from the past. As the Federal Reserve continues to navigate inflation, as potential recession signals persist, and as local economic conditions shift rapidly, this disconnect will likely continue and possibly widen. Markets reward the patient and the prepared. The prepared understand that algorithms are tools, not oracles. Stay informed, adapt to changing conditions, and make decisions based on current fundamentals, not historical assumptions. If this video provided valuable insights into navigating today's real estate market, subscribe and ring the bell. We're dropping a comprehensive guide on navigating